Ladies and gentlemen, gather round. Hold on to your wallets and your jobs. Donald Trump is coming back to the White House, and it seems like everyone's tuning into what feels more like The Apprentice, Economic Edition, than a standard government transition. This time, he's pulled out the heavy artillery with promises of massive import tariffs, record deportations, and an attempt to get his hands on the Federal Reserve steering wheel. Economists, many of whom, to be fair, have been wrong before, are warning that Trump's next term could drive inflation up and spark sluggish growth. And if there's one thing we know about inflation, it's that wages will fall behind. You'll be paying more for imported goods, and no voter wants to pay made in China prices for a knockoff economy. So, before we let ourselves get caught up in the media frenzy, let's break it down from the ground up, from the financial markets all the way down to real-world workers. What happens next if Trump's trade wars, tax cuts, and deportation plans become a reality? First things first, tariffs. Get comfortable with hearing about them, because Trump is doubling down in his narrative as the self-proclaimed tariff man. The last time he was in office, he slapped taxes on around $380 billion worth of U.S. imports. Now, he's aiming to impose a 10% to 20% charge across the board on all imported goods. Essentially, a tax on every single item we bring into the U.S., with a special 60% whopper on Chinese imports. His stated goals: raise revenue for his economic initiatives, reduce the U.S. trade deficit, and reshore American manufacturing by making it better for companies to buy American. It sounds great in theory, and there's no denying that it sells well to parts of his voter base, a shrinking manufacturing class still nostalgically clinging to Rust Belt industrial powerhouses. But here's the thing, tariffs rarely work without causing a tsunami of negative side effects. Let's strip this concept down to what really matters for the average American. More tariffs equal higher prices for goods, folks. It doesn't matter if you're a farmer in Wyoming or a tech company in Silicon Valley. Moody's Analytics estimates that inflation, which stood at 2.4% before all the election drama, would jump to over 3% in a hurry under Trump's new tariffs. And if he gets his promised Senate sweep? Well, buckle up, because inflation could go even higher. Let's face it, businesses will pass those costs directly on to consumers. Want a new phone? A washing machine? Groceries? You'll be paying more across the board. Add to that the ongoing supply chain disruptions, and it's no surprise that many economists, including Mark Zandi of Moody's, expect tariffs to be a short-sighted solution that inflates prices immediately without bringing back long-term economic balance. Another problem with tariffs that too many fail to realize: trade isn't a one-way street. At the rate Trump is swinging around tariffs as if they're free money spigots, don't be surprised if our trading partners start fighting back. Remember those retaliations from the Chinese last time? Steel, soybeans, and other key products were hit hard. We're already seeing murmurs of China and the EU preparing countermeasures if Trump actually follows through. And what does that mean for us? It'll hurt crucial U.S. export industries way more than pundits want to admit. Not only will businesses that rely on international trade suffer, but agricultural states like Iowa, Minnesota, and Ohio, key battlegrounds during elections, could take heavy hits. The so-called winners would wind up losing, and the cycle would drag the economy into a mini stagflation crisis, where GDP stalls and inflation keeps rising. When everyone is busy slapping tariffs on each other like a global game of whack-a-mole, the inevitable result is economic stagnation. Economists at Wells Fargo expect these shocks to slow U.S. growth substantially. Solid numbers suggest GDP growth could plummet to under 1.5% annually in the coming years if a full-on trade war reignites. It wouldn't be Trump without some pretty explosive talking points on immigration. Mass deportation is a central plank of his platform, deportations on a scale that hasn't been attempted before, possibly removing millions of undocumented workers. Trump's plan is to cut off a sizable chunk of the labor supply with the assumption that this will free up jobs for Americans, especially in low-wage sectors like agriculture, construction, leisure, and hospitality. But here's where things get complicated. Removing millions of workers doesn't necessarily mean those jobs will magically be filled. Imagine trying to replace an entire workforce overnight. Bloomberg Economics estimates a stark 3% drop in GDP if Trump's deportation drive goes according to his rhetoric. The sectors hit hardest will be construction and hospitality, arenas that have come to rely on migrant labor to function. States like Texas, Florida, and California will feel the dip first, with key housing markets slowing due to a shortage of laborers to build homes or work on existing infrastructure. The reality is that while deportations may appeal to some voters, businesses and economists know that filling those jobs isn't a quick process. The U.S. labor market, which already faces worker shortages due to the post-pandemic, stay-at-home economy, would struggle to bounce back from such dramatic restrictions. Many of those jobs, especially in agriculture, are simply not attractive to domestic workers, given the low pay and harsh conditions. Moreover, the reduction in labor availability would drive up costs further for industries dependent on lower-wage migrant workers, adding more fuel to the inflation fire. And no, before we go further, cutting back on immigration doesn't automatically stabilize wages for American workers, a fact verified in studies conducted by the National Academies of Sciences and immigration think tanks alike. But here comes the piece de resistance. Donald Trump wants to stick his fingers into the cookie jar known as the Federal Reserve. He's pointed out in interviews that he should have a say in interest rates because his instincts regarding economic trends are so incredibly sharp. Imagine the executive branch storming in and dictating to Jerome Powell, or worse, replacing him with a hand-picked loyalist. Historically, any time politicians interfere with the Fed's monetary decision-making, it doesn't end well. Look at countries like Argentina and Turkey, notorious for disastrous policies led by political meddling. Interest rates may fluctuate wildly, and uncertainty alone could drive significant volatility in the financial markets. Investors thrive on predictability, something the Federal Reserve has strived to maintain with its slow and steady rate hikes post-pandemic to curb inflation. If Trump were to overrule the Fed to lower interest rates, as he suggested, we could trigger an inflationary spiral. That would spell not just higher prices, but new debt problems as the cost of borrowing rises unpredictably. The investment community and businesses alike would face major uncertainty about future economic policies, lowering incentives to invest or hire, reducing long-term growth even more. Now that we've walked through the minefields of tariffs, immigration, and the potential compromising of the Federal Reserve, let's turn to Trump's tax plans. He promises household tax cuts, more reductions for small businesses, and a sweeping elimination of the estate tax by 2025. Remember the 2017 tax cuts? They were initially hailed as good news for corporations and the wealthy, but the bill for middle-class families was left out to dry by the time inflation kicked in. Trump's latest tax agenda. More of the same, according to nonpartisan assessments, piling an estimated $10 trillion in debt over 10 years. You can't fund this level of tax reduction without serious costs. Trump continues to argue that tariffs will somehow fund the tax cuts, but the numbers just aren't there. The Peterson Institute predicted that tariffs, after counting in retaliations, may only raise fractions of what Trump suggests, leaving a gaping fiscal hole in the Treasury. And yes, while tax cuts often encourage immediate spending gains, when combined with rampant price hikes caused by tariffs, their net effect flips quickly to the negative. This deficit gap can't be ignored, especially with a potential debt ceiling crisis in 2025. The GOP might sweep the Senate, but the House could still pose a formidable roadblock to get these policies through without heavy compromise. On the energy front, Trump has signaled his continued belief in heavy deregulation, especially for oil and gas drilling. His logic mirrors that of 2017, that free market oil production will lower prices and forcefully boost growth. Sure, we could see cheaper gasoline in the short term, but there's a catch: loosening environmental regulations might bring about significant long-term costs for climate-related disasters, and hefty infrastructure damage is already on the horizon from hurricane sprees like the disasters seen recently in Florida and Louisiana. And let's not ignore the imbalance here either. While this might benefit certain sectors, consumer pockets won't feel relief in industries losing cash from higher import taxes unless oil prices plummet, which isn't guaranteed. So, where does all this leave us? Trump's economic plans represent, essentially, a huge gamble, a high-stakes bet that aggressive tariffs, sweeping tax cuts, massive deportations, Fed meddling, and ultra-deregulation will somehow reignite American growth, despite overwhelming evidence suggesting otherwise. As he prepares to re-enter the White House with an agenda that sounds equal parts populist and market disruptive, it's crucial to step back and consider the broader impacts across the U.S. economy and the individuals who will bear the brunt of these decisions. 1. Higher inflation and consumer fallout. Combining broad-based tariffs on imported goods with labor shortages from deportation will fuel consumer prices. You'll be paying more for the essentials. We already see inflationary pressures at the grocery store and in durable goods, and placing additional tariffs will only exacerbate this. While Trump's economic narrative often focuses on helping the forgotten men and women of America, the reality is that inflation disproportionately harms lower and middle-income households. These groups allocate a larger share of their income to necessities like food, energy, and housing, goods that are most sensitive to price increases from tariffs and supply chain disruptions. The inevitable rise in consumer prices could erode any real wage gains, making Trump's broader economic agenda not only counterproductive but deeply harmful to the very people it claims to protect. 2. Slower growth, more uncertainty. Economists like Jay Bryson, Wells Fargo, and Mark Zandi, Moody's, have repeatedly warned that Trump's trade policies could trigger a stagflationary shock, slowing economic output while increasing prices, a nightmare combination that would strain businesses, reduce investment, and put downward pressure on job creation. The unpredictable nature of tariffs and trade wars introduces tremendous uncertainty into the business environment. With companies unsure when the next tariff hike might hit or whether supply chains will be disrupted, investment slows. Firms greatly value stability and predictability when making long-term investment decisions, and Trump's policies would do anything but provide that clarity. 3. Labor market shocks, deportation equals worker shortages. As Bloomberg economics analyst Chris Collins pointed out, mass deportations, particularly across key sectors like construction, agriculture, and hospitality, mean those jobs won't easily be filled by American-born workers. This labor shortage would fuel wage pressures in these industries, driving up business costs and reducing productivity, further constraining economic growth. The logistical challenges of deportations create massive disruptions in the labor market. As we've seen in past studies, many Americans are not likely to take up jobs vacated by migrant workers due to the perceived disparity between wages and the physically demanding nature of the work, thus leaving those industries with a labor void that could take years, if not decades, to fill. 4. Debt and deficits, mounting fiscal challenges. The $10 trillion hole that Trump's proposed tax cuts would leave in the U.S. Treasury is staggering and unsustainable. Meanwhile, the supposed offset from tariff revenues is pure fantasy. As the Peterson Institute estimated, existing tariffs haven't raised anything close to enough to balance out government spending. Add to this the looming debt ceiling battles and you've got a perfect storm. If Trump refuses to compromise with Democrats on budget issues, or if his fiscal policies exacerbate the national debt, America may find itself once again careening dangerously close to default, jeopardizing global financial stability. The tax cuts, set to expire in 2025, will come back into focus as Trump pushes for permanence. But if achieved, this tax policy will greatly inflate the already ballooning national deficit. Larger deficits mean more government borrowing, pushing up interest rates and crowding out private investment, which will dampen future economic growth. 5. Energy deregulation and environmental risks. Trump's emphasis on domestic energy production and deregulation will certainly provide a boost to the oil and gas industry in the near term, but the potential returns aren't as strong when you consider the growing global shift toward renewables and clean energy technologies. Heavy fossil fuel reliance may provide a temporary economic lift but risks isolating the U.S. from the international race towards green technology, ultimately costing jobs and competitiveness. Deregulating energy safeguards and ignoring climate risks could impose enormous long-term costs. Extreme weather events have intensified due to climate change, and the costs of repair and recovery from hurricanes, wildfires, floods, and droughts will continue to rise. These expenditures will ultimately land on the shoulders of taxpayers, thereby negating the short-term gains in energy price reductions. Many Americans will recall Trump heralding his policies during his first term as a roaring success, pointing to the pre-pandemic economic boom as evidence that his vision is the path forward. The reality, however, is that while tax cuts and deregulation provided an initial macroeconomic sugar rush, they were accompanied by ballooning deficits and trade imbalances that were unsustainable. Yes, from 2017-2019, GDP growth was healthy, averaging around 2.5% annually, and unemployment fell to record lows. But this expansion was largely driven by the same factors that propelled the U.S. economy under Obama: cheap credit, low interest rates, rising corporate profits, and strong consumer spending. Then came Trump's tariffs. After launching trade wars with China, the European Union, and Canada, U.S. manufacturers faced rising input costs and lower demand. The National Bureau of Economic Research concluded that the tariffs failed to increase jobs in protected industries and hurt industries that got caught up in the retaliatory crossfire. Farming communities, in particular, bore heavy losses as Chinese counter-tariffs decimated demand for key U.S. agricultural products. The pandemic stress test tore apart the illusion of Trump-era economic invincibility. Suddenly, irreparable cracks in the foundation, namely soaring deficits, rising inequality, and trade war damage, came to light. Post-COVID economic recovery was, in large part, due to massive government spending pushed forward by Congress and the Federal Reserve, not the policies of the executive office. Trump's policies are constructed around a populist narrative, and no doubt many corporations, particularly those in select industries like energy and heavy manufacturing, will benefit in the short term. But there isn't much for everyday Americans to take home here. Why? 1. Families face rising costs. For the average American consumer, higher tariffs mean higher inflation, while tax cuts targeted at the wealthy will do little to relieve their day-to-day financial pressures. Housing, cars, electronics, food, everything becomes more expensive under a trade war scenario. 2. Workers lose jobs, and recovery isn't guaranteed. The sectors that depend on migrant labor, agriculture, hospitality, construction, could experience severe disruptions while businesses grapple with the change. Add to that a potential economic slowdown, and U.S. workers aren't the beneficiaries of these changes. The most at-risk groups. Low-wage earners who need those jobs most. 3. The greater economy loses innovation progress. Trump's heavy focus on energy deregulation is short-term thinking. While oil and gas jobs might benefit initially, much of the rest of the world is accelerating into cleaner technologies. An economy focused too much on the past risks stagnating as its peers invest in the industries of the future: clean energy, biotech, AI, and advanced manufacturing. Ladies and gentlemen, this isn't new territory for those who have been following Trump's economic policies. The former president is betting that bold tariffs, broad-based cuts to regulation, and populist immigration clampdowns can awaken the mythical dormant giant of American manufacturing. But what he offers in theater, he lacks in coherent sustainability. The reality is that his economic model, a blend of nationalist fantasy and economic roulette, comes at the risk of global isolation, rising consumer hardship, widening fiscal deficits, and environmental degradation. Trump tends to downplay the longer-term consequences. Sure, action on tariffs, energy, and immigration may fire up rally crowds, but governing requires more than a tough campaign quip or two. It involves negotiation, careful planning, and yes, a good dose of realism. So, for those watching closely, keep your eyes on the numbers, the wages, the prices at the pump, and the jobs in your town. Trump's second term is set to be a wild economic ride, and unfortunately, it doesn't look like American families, workers, or consumers will be the winners this time around.